But we move on and talk about Dabur then. Pardon me. And my colleague Mahima now joins us to tell us about how the quarterly update has come through and what brokerage houses are making of it. Mahima.
Dabur Q2 FY25 update has been, not just a bit, but it has been disappointing, and this is because they expect operating margins to decline, in mid to high teen levels, and they expect revenue growth to revive from October 24. Now, what they said is that they expect revenue growth. They're seeing mid-single-digit decline in consolidated revenue overall. Now, this is on the back of multiple reasons. First off, heavy rains and floods across India has impacted the overall consumer offtake in Q2 FY24. Plus, there has been a significant shift that has been seen to quick commerce and e-commerce, that is the modern trade from the general trade, and that is why there are high inventory levels when it comes to general trade. And the management is now, taking up the shift from general trade to modern trade, which is why there are high inventory levels and margins will take a hit. In terms of international business, it has registered double-digit constant growth, and in terms of beverages, it saw some impact due to heavy rains again. Now, in terms of what brokerages have to say about Dabur, well, MK has downgraded Dabur to add from buy with a target price of 650, which is cut down from 750, and they're seeing earnings cut between 8 to 11%. However, they remain hopeful of business recovery in near future. Now, City on Dabur, they've maintained sell and they've reduced the target price to 570, which gives a downside of roughly 8%, and the stock itself is down around 6% in trade today. And they believe that quantum of impact of inventory pileup is fairly high and roughly 10% on growth, and they've cut FY25 to 27 estimates, earnings estimates by 3 to 6%, and they forecast 5% decline in consolidated revenue, 17% decline in EBITDA, and 19% decline in recurring PAT. Lastly, Nuvama on Dabur, that is maintained, this is a very contradictory note. They've maintained buy with a target price of 760, which poses an upside of 23% from its Tuesday's closing price. What they're saying is that they are expecting some near-term pushback for Dabur. However, they expect A&P as a percentage of sales at 7% in Q3. They're expecting EBITDA margins to fall roughly by 213 basis points, and they expect consolidated revenue to fall around 5% again. But there was a very interesting note by Jefferies also on India Consumer. What Jefferies has said is that Dabur is expected to report a decline in operating profits, but they do not expect this same trend for their peers. And lastly, what they're saying is that unless the management commentary is positive in H2, there's a possibility of some correction in the entire staple space.
Okay, Mahima, thank you so much for getting us that on Dabur. Raghvendra, how are you assessing Dabur at this point in time? What's your view?
Agam, if you look at the full year EPS of Dabur at current levels, it is somewhere in the range of 8 or 9 rupees. Even if we extrapolate that with some positive bias and expect the full year earning per share to be around 10 rupees, still it gives a very astronomical P multiple, price to earning multiple of around 58 times to Dabur India. With that said, there remains very little room of a margin of error in terms of their guidance. Now they have forecasted or indicated in terms of a revenue decline, EBITDA decline, PAT decline. So that multiple of 58 times should not be warranted. We believe that the stock could correct further, come to levels of 520, and then when it should be reviewed. And also by the time we can have a Q2 commentary. There are a few disruptions going on in terms of losing its market share, or as you indicated, that with the quick commerce industry picking up, there is some kind of a disruption at a local level from local brands where the entry barriers have significantly reduced, which threaten the pan-India marketing distribution presence of large cap names like Dabur India. So that disruption from quick commerce players plus guidance on the lower side plus expensive multiples, we would avoid Dabur at current levels and expect it to fall to levels of 520, which is where we would review again. And also Q2 commentary remaining upbeat might positively look at it. Until then, it's an avoid.
All right.